Bitcoin is down 24% from its all-time high, with whales selling and fear gripping the market. But what if this downturn is exactly what a market bottom looks like? Wall Street giant JPMorgan has just called the floor, and the on-chain data tells a compelling story. It's been a tough few weeks for Bitcoin holders, as the price has taken a nosedive from its record $126,000 to hover around $95,000. While the Nasdaq 100 has been hitting new highs with a plus 20% year-to-date performance, Bitcoin's year-to-date performance is only plus 3%, leaving it behind. To truly understand where Bitcoin is headed, we need to look beneath the surface at the fundamental forces shaping this global, interconnected crypto market. JPMorgan, a major financial institution, has made a bold call, identifying a price floor for Bitcoin at $94,000. Their reasoning is based on the cost of production, estimating it costs miners roughly $94,000 to produce one Bitcoin. Historically, this production cost has acted as a solid floor for Bitcoin's price, providing a strong support level. Just this week, we saw the price dip to that exact $94,000 level before bouncing, which JPMorgan views as a confirmation, not a coincidence. They are so confident in this analysis that they have reiterated a $170,000 price target for Bitcoin by 2026. This confidence is further underscored by the bustling activity on Wall Street, where major financial players are constantly evaluating these market signals. Beyond production costs, an even more compelling signal is flashing: the negative skew. This means Bitcoin is falling harder on bad days than it's rising on good ones, an asymmetric response that might sound bearish, but historically signals the opposite. This pattern typically appears near major market bottoms, indicating that sellers are exhausted and capitulation is nearing its end. The last time we observed this level of negative skew was in late 2022, right before the start of the last major bull run, drawing clear parallels to the current situation. The on-chain data further confirms this narrative of seller exhaustion and a potential market bottom. We are witnessing massive capitulation from short-term holders, those who bought at higher prices and are now selling at a loss. This widespread selling by short-term investors is a classic bottom signal, indicating that the weakest hands are being shaken out of the market. Simultaneously, a huge wall of accumulation is forming in the sub-$100,000 range, driven by smart money and long-term believers. These strong hands are absorbing the panic selling, building their positions, and transferring supply from those who can no longer hold. However, it's crucial to acknowledge that the market is not without its risks and uncertainties. We face uncertainty around the Federal Reserve's next policy moves, which could impact market liquidity and investor sentiment. Additionally, ETF inflows have slowed, and some long-term holders are taking profits, adding to selling pressure. There's also a massive wall of resistance between $106,000 and $118,000 that will be tough for Bitcoin to break through. And while a death cross pattern is present in this strange new cycle, it has often paradoxically been a bullish, not bearish signal. So, is Bitcoin hitting bottom? While nothing is guaranteed, the evidence is compelling. We have JPMorgan calling a floor based on production costs, a rare historical indicator signaling seller exhaustion, and on-chain data showing a massive transfer of wealth. This may not be the absolute bottom to the dollar, but the signs are clear. We are in a bottoming process. For long-term investors, this could be the accumulation opportunity they've been waiting for, a chance to build positions at favorable levels. What do you think? Are you buying this dip? Let us know your thoughts in the comments below. Don't forget to like this video and subscribe for more deep dive analysis. Thanks for watching. Please remember, this content is for educational purposes only and should not be considered financial advice.